when it comes to transfer pricing, some of the indirect taxes seem to be ignored. If a company is not registered for VAT, for example, in Kenya, it pays withholding taxes on freelancers, external consultants, and operates on a cost-plus method. Doesn't this result in a double or even triple taxation? Not in the sense of corporation tax, of course. Yes, you're correct. When we're thinking about transfer pricing, we often don't think about these indirect taxes like VAT and withholding taxes. We focus on corporate income tax, profit attribution, and ensuring the compliance with the arm's length principle. But it's equally important to make sure that we don't overlook these indirect taxes. VAT and withholding taxes, for example, can significantly complicate transfer pricing equations, especially when they interact with pricing methodologies like the cost-plus method that you mentioned. Ignoring their impact can lead to unintended consequences, including multiple layers of taxation, as you suggest. So let's take the scenario that you've provided of Kenya, and to illustrate this, we're going to use an example. So let's imagine there's a company that provides services to its related entities in Kenya operating a cost-plus pricing model. The company engages with freelancers or external consultants to support its operations, but it is not registered for VAT. This introduces, obviously, a fundamental issue. So without the VAT registration, the company cannot charge VAT on its services, or it cannot reclaim VAT on any goods and services that it procures or buys. As a result, the VAT it pays becomes an additional cost that it has to absorb. Now, under the cost-plus method, this non-recoverable VAT forms part of the cost base used to calculate the markup. Essentially, the VAT, which is already a tax, is treated as a business cost. When the markup is applied, the VAT inclusive cost is increased further, inflating the price charged to related entities. So you can see that there now. This means that the end consumer or the next party in the chain effectively bears the burden of the embedded VAT cost, the VAT plus the cost plus markup on top of that. So let's complicate things even further by adding withholding taxes now. So in Kenya, payments made to freelancers or external consultants are subject to withholding tax, which the company must obviously deduct and remit to the Kenyan Revenue Authority before paying the freelancer or external consultants. So this tax is effectively borne by the freelancers, but it impacts the company as well. And this is when these consultants' costs are included in the cost base, the markup under the cost plus method is again applied on amounts already taxed. So this time via withholding tax. So the result is a compounding effect. VAT becomes part of the cost base and withholding tax becomes another layer, and the markup amplifies the overall tax burden. So what we're seeing here is not traditional double taxation in the sense of corporate income tax being taxed twice across jurisdictions, but instead it's a form of tax on tax within the structure of indirect taxes and transfer pricing. By the time the product or service reaches its final consumer, the cascading tax effect is obviously significant, as you can imagine. So how does one address this? Well, one, VAT registration can make a critical difference. So entities like this should try and VAT register, which will then change these VAT outputs, enabling them to reclaim on its inputs, and then breaking the cycle of cascading tax costs there. But beyond that, transfer pricing policies must be carefully designed to exclude tax components, such as non-recoverable VAT or withholding tax, from the cost base used for pricing calculations. So this ensures that the markup is applied only to actual business costs and not to the taxes. And obviously, additionally, strategic planning is also essential. So companies need to consider the interplay between direct and indirect taxes in every jurisdiction where they operate. This includes understanding local VAT and withholding tax rules, examining how these taxes interact with transfer pricing methods, and obviously proactively managing their tax obligations to avoid unintended consequences. So just to recap, indirect taxes like VAT and withholding taxes are integral to the financial and operating reality of multinational enterprises. Obviously, by recognizing the impact and addressing them strategically, companies can avoid the pitfalls of multiple layers of taxation and achieve more efficient tax structures.